oil's still in the 40s. Things are not looking good for 2016. We talked about defaults before, but is every company but Exxon and Chevron going to go under before this is over?
That might be pushing it just a little bit.
I like to speak in hyperbole for comedic effect.
That is quite the hyperbole, but
that would solve everyone's problems in 20 minutes or less.
Cure for low prices is low prices, baby.
We talked about this. What was it? Maybe
2 months ago.
January. We've talked about it a lot.
Yeah.
We talked about it in November. We talked about it in January. We've talked about it in March.
But we mean it this time, darn it.
I think one of the reasons that we haven't seen that reaction of defaults and people getting in financial trouble is, well, in all honesty, two things. One, I think a lot of people expected oil prices to be a little bit more robust than they are right now. I mean, if we go back to November, December, you hear all these, wildcatter style CEOs and guys like Pickens and stuff like that. We'll be at 70 in 6 months or
end of the year.
End of the year, we're back at 70. And, everybody kind of hung on to that and be like, okay, we'll get through this. This sucks, but we'll get there. And we're 45.
It's almost Thanksgiving.
45, 50 days from the end of the year, and we're still below 50. It's starting to really weigh on a lot of these people who thought they could weather a short-term storm. And, well, that storm is a little bit longer than they expected. And so many of these players that we had talked about, we knew they were going to be in trouble when oil prices were low. You looked at their balance sheets, you saw they had taken on a ton of debt, but at the same time, I guess they just held on for a little bit longer than everybody expected. I guess people are more resilient in that fact where they want to say, we'll hang on, we can make it through. But,
Well, and the other reason that pain hasn't been quite felt is hedges, of course.
That has helped to a certain degree. There's a lot of companies that have that in place, especially when you look at, let's say master limited partnerships that are in production. They have those hedges to kind of steady out their cash flows. But at the same time, there's a lot of people who didn't have that and have just, had to slash their capital budgets, their operating expenses down to the absolute floor to make it as profitable as possible. Some have been able to achieve some marginal level of profitability, which is quite commendable. But at the same time, when again, going back to their ability to pay off debts, it's getting a little bit harder.
I think some of the people that are facing these defaults probably didn't utilize hedges that much because they were those guys that were just saying, why are we going to forego profits now with these silly hedges? This is just going to crimp our returns now. Who knows what the future holds? What if oil prices stay at $150? These hedges are going to they're going to ruin our stock price.
Was it Harold Hamm that cashed in his hedges a year ago now?
Yeah, right about.
Yeah.
So, like I said, looking at these companies, you're talking about some names that were really popular names among investors, among the energy inner circles during the last 4 to 5 years of the boom leading up to the November of last year, and now all of a sudden their debt is essentially worthless. At least that's what they're predicting in the next few months. Penn, Virginia, I think, is coming up on some covenants. Magnum Hunter Resources, they mentioned in the report that Tyler sent around, is basically already defaulting. And those two companies, while they're not huge, they're only domestic E&Ps, but those were some hot stocks. Those were very, very popular, and now they're reaching.
So was oil at 45 just because everybody's been holding on?
It's below 45 right now.
Well, yeah, it's
almost
42, 43.
Yeah.
It's just holding on. I mean, you see inventories continue to creep up, but production's falling. It's just people just putting it there because they don't want to sell it at 45.
Well, I mean, again, to these companies, they have to generate cash to, pay these loans off to a certain bit, so they can't just shut off the taps, especially like you said, Penn, Virginia,
right.
Magnum Hunter.
Magnum Hunter, the article said that they have debt coming up this month that they can't pay.
Oh, geez.
Yeah, so, these companies, they can't turn off. They can't just, stop producing because they need cash now. It's like those dumb annuity commercials.
Right.
They always say, I need cash now. But right now, there's just too many of them out there.
If only there was a payday lender for oil companies.
There were, and now
it's called Wall Street.
There were, and now it's gotten to the point where not even payday lenders will toss them a bone.
And so with those people that aren't in that flexibility to say, well, we just can't stop drilling, or we can't stop producing, that it kind of has compounded the issues that we have seen so far. I mean, obviously, you've got some of the larger, more well-capitalized companies, the EOG Resources, ConocoPhillips, people like that, who have scaled back and said, we can, even though some of them are more profitable at much lower prices today, they're still scaling back and saying, we can take our foot off the accelerator for a little while. And
that's not because they're smart now. It's because they were smart before. They weren't taking on these crazy amounts of debt. They weren't drilling out of control. It's kind of a dominoes effect here with these companies, that they're able to do this because they were smart 5 to 10 years ago when they were first realizing that this is a gold mine, but it's not going to last forever because, hey, the energy industry
is
a
cyclical business.
Yeah, they got it, and some companies that didn't it's evident every time the bottom hits or comes close. Some companies just didn't have the experience or the wherewithal to kind of pace themselves.
Yeah. And certainly as investors and people like us, that couple years before, it was kind of one of those starry-eyed sort of moments where we looked at it and said, we can take control of the market back, where we can, produce all of our own oil and
energy independence.
And seeing these companies that were just growing at gangbuster-like levels, almost doubling production every year. It sweeps you up. It really does as an investor. And you see all these companies that are just growing so fast, and you want a piece of that. But at the same time, again, going back to the fact that it's a cyclical business, if you're an investor in the space, certainly a lesson I learned in some ways the hard way from this one is that we have to be measured in our approach throughout through the down market and through the up markets. That last one, we all got caught up in it, and it probably burned quite a few people. And today, at the same time, don't overlook the fact that there's a lot of value in buying solid energy companies today. Don't just get burned back then and now today completely go away from energy, because there are some opportunities out there. And when this market does turn, it will eventually.
Yeah.
When it does, you will have some. I think there's a great opportunity for some long-term rewards.
So before we move on, just bottom line, it seems like some companies got to die for production to really drop. I mean, is that basically what we're saying here?
The crematories are firing up their furnaces.
Okay,
yes.
That's dark, but
using
true.
oil
Dark,
to fire
but
up their furnaces. Cheap,
No,
cheap
natural
oil.
gas. It's a $2.50.
Either way, they're both cheap.